Let me ask you a simple question. If you had $200,000 today, could you realistically turn it into millions without winning the lottery or starting the next tech unicorn? Most people think it's impossible. But the truth is, the math says otherwise. And once you see this math, you'll never look at money the same way again. In this talk, I'm going to break down the exact financial principles that transform ordinary capital into extraordinary wealth. This is not hype, not hustle culture, and not risky gambling. This is pure compounding, smart allocation, and time doing the heavy lifting. By the end, you'll understand how $200,000 can quietly grow into multiple millions, and more importantly, how you can apply this logic in your own financial life. Compound interest is the engine that turns ordinary money into extraordinary wealth. It is not flashy, it is not fast, and it rarely gets attention in viral finance videos. But it is the quiet force that has created more millionaires than any single business idea or stock tip in history. When you invest $200,000 and reinvest the returns instead of spending them, you are no longer relying on your own effort to grow your wealth. You are letting your money work for you, and then letting the money your money earns work for you as well. That is the key difference between linear growth and exponential growth. Most people think growth happens in a straight line. They imagine adding a fixed amount every year and slowly climbing. Compound interest does not work that way. It starts slow, almost boring, and then suddenly it accelerates in a way that feels unreal. In the early years, your account grows mostly because of your original $200,000. But after enough time passes, the majority of your wealth comes from the returns on your returns. That is when compounding becomes mind-blowing. Imagine your $200,000 earning a modest 10% per year. In the first year, you make $20,000. That feels good but not life-changing. In the second year, you are no longer earning 10% on $200,000. You are earning it on $220,000, then $242,000, then $266,200. The growth keeps stacking. After 20 or 30 years, the account value is no longer growing by thousands, but by hundreds of thousands per year. At that point, your money is growing faster than you could realistically save from a job. The real magic of compound interest is psychological. It rewards patience and punishes impatience. If you interrupt the process by withdrawing, timing the market, or jumping in and out of investments, you break the compounding chain. But if you stay invested, reinvest dividends, and ignore short-term noise, the math keeps working in your favor. The difference between someone who lets compounding run for 10 years versus 30 years is not 3 times more money. It is often 10 times more money, or even more. This is why wealthy investors focus obsessively on long-term returns, not short-term wins. They understand that the first million is usually the hardest, and the next few millions come faster because compounding has momentum. Once your capital base is large enough, even average returns create extraordinary results. A 10% return on $200,000 is $20,000. A 10% return on $2 million is $200,000. Same rate, completely different life impact. Compound interest also changes how you think about spending. Every dollar you spend today is not just a dollar gone. It is the future compounded value of that dollar lost. When you truly understand this, you start seeing money as seeds instead of cash. Some seeds grow into trees that feed you for decades. Others get consumed instantly and disappear. This is why the math behind turning $200,000 into millions is not mysterious or reserved for geniuses. It is simply compound interest, applied consistently with time and discipline. The formula is simple. The patience is hard, but the reward is life-changing. Time is the most underestimated asset in personal finance, and at the same time, the most powerful multiplier you will ever have. People focus on how much they invest, what stock they buy, or which property they choose, but the real driver of turning $200,000 into millions is how long that money is allowed to compound without interruption. Time does not just add to your wealth, it multiplies it. When you invest, you are essentially making a deal with the future. You are trading comfort today for freedom tomorrow. The longer you give your money to grow, the less you have to rely on high-risk strategies. A person who starts with $200,000 at age 30 has a completely different outcome than someone who starts with the same amount at age 50, even if both earn the exact same returns. Those extra years are not just extra growth. They are extra layers of compounding stacking on top of each other. In the early years, time feels invisible. Your portfolio grows, but not in a dramatic way. It can feel slow and even disappointing. This is where most people give up, thinking they are wasting their time. But compounding is backloaded. The biggest gains happen in the later years. The first decade builds the foundation. The second decade builds momentum. The third decade creates the explosion. Time is what turns steady growth into a snowball that becomes impossible to stop. This is why starting early is more powerful than starting big. Someone who invests $50,000 in their 20s can outperform someone who invests $200,000 in their 40s, simply because the first investor gave compounding more time to work. Time allows small amounts to grow into large sums and large sums to grow into massive wealth. It levels the playing field between people with different starting points. Time also reduces risk. When you invest over long periods, market crashes, recessions and volatility become noise rather than disasters. You are not trying to guess what will happen next year. You are letting decades smooth out the chaos. Over long periods, the stock market, real estate, and productive businesses have historically grown despite wars, pandemics, and political changes. Time gives you resilience that no trading strategy can replicate. There is also a behavioral advantage to long-time horizons. When you think in decades, you stop reacting emotionally to headlines and market swings. You stop chasing trends and start focusing on fundamentals. You become an owner rather than a speculator. This mindset shift is what separates investors from gamblers. Turning $200,000 into millions is not about finding a secret investment. It is about giving your investments the gift of time. Time allows compounding to do its job, volatility to work in your favor, and discipline to compound alongside your money. In finance, time is not just money. Time is the multiplier that turns money into wealth. Strategic asset allocation is the blueprint that decides whether your $200,000 grows into millions or stalls at mediocrity. Most people obsess over picking the perfect stock or the next hot investment, but the reality is that how you spread your money across different assets matters far more than any single pick. Asset allocation is about positioning your capital so it can grow, survive downturns, and take advantage of multiple engines of wealth at the same time. When you put all your money into one asset, you are making a bet, not a plan. A single stock, a single property, or a single business can make you rich, but it can also wipe you out. Strategic allocation means combining assets that behave differently. When one is struggling, another is often performing well. This balance is what allows your portfolio to keep growing steadily instead of riding a financial roller coaster. Equities are usually the primary growth engine. Stocks represent ownership in productive businesses, and over long periods, they tend to outpace inflation and most other asset classes. Real estate adds a different dimension. Property can generate rental income, appreciate over time, and provide leverage through financing. Businesses, whether private ventures or equity stakes, offer high growth potential and cash flow, but they come with higher risk. Bonds and fixed income assets add stability and reduce volatility, acting as a cushion during market downturns. Cash and equivalents provide liquidity and flexibility, allowing you to seize opportunities when markets are stressed. The art of allocation is not about maximizing returns in good times. It is about optimizing returns across all times. A portfolio that is too aggressive can grow fast, but may collapse during a major downturn, forcing you to sell at the worst moment. A portfolio that is too conservative may feel safe, but will struggle to reach millionaire status. Strategic allocation finds the middle ground, where growth and stability work together. Asset allocation also evolves with time. Early in your journey, you can afford to tilt more toward growth assets because you have time to recover from volatility. As your wealth grows, you may gradually shift toward more stable assets to protect what you have built. This dynamic approach is what sophisticated investors use to preserve and expand wealth across generations. Another overlooked benefit of allocation is psychological. When your portfolio is diversified, you are less likely to panic. You do not feel like everything is collapsing at once. This helps you stay invested, which is essential for compounding to work. Emotional discipline is easier when your portfolio structure supports it. Turning $200,000 into millions is not about gambling on a single idea. It is about building a system where multiple assets work together, each playing a specific role. Strategic asset allocation transforms investing from guessing into planning, and planning is what turns capital into lasting wealth. Consistent returns are the unsung hero of wealth building. People are naturally drawn to dramatic stories of someone turning a small amount into a fortune overnight. Those stories are rare, unpredictable, and often exaggerated. The real path from $200,000 to millions is paved with steady, repeatable gains that compound year after year. Consistency is not exciting, but it is powerful. When you earn a reliable annual return, even if it feels modest, you create a predictable growth curve that becomes extraordinary over time. An 8 to 12% annual return may not sound impressive compared to speculative investments that promise triple-digit gains, but over decades, that steady rate quietly outperforms most high-risk strategies. The reason is simple. High returns are often followed by high losses, while consistent returns keep compounding without major interruptions. Consistency also protects you from behavioral mistakes. Investors who chase big wins often jump in at market peaks and sell during crashes. They are reacting to emotions rather than executing a plan. A strategy focused on consistent returns encourages discipline. You are less tempted to trade frequently, less likely to overreact to news, and more likely to stick with a long-term approach. Over time, avoiding big mistakes matters more than making brilliant moves. There is also a mathematical advantage to consistency. Volatility reduces compounding. If your portfolio gains 50% one year and loses 50% the next, you are not back to where you started. You are down. Smooth, steady growth compounds more efficiently because there are fewer drawdowns to recover from. This is why professional investors emphasize risk-adjusted returns rather than raw returns. A portfolio that grows steadily with controlled volatility can reach millions faster than a portfolio that swings wildly. Consistent returns also make planning easier. When your investments grow predictably, you can make informed decisions about saving, spending, and reinvesting. You can estimate future wealth, plan for retirement, and allocate capital to opportunities with confidence. Unpredictable returns create uncertainty, which often leads to paralysis or impulsive decisions. Another key benefit is compounding of confidence. When you see your portfolio growing steadily, you build trust in your strategy. That trust makes it easier to stay invested during market downturns. You understand that short-term drops are part of the journey, not a signal to quit. This mindset is essential for long-term wealth creation. Turning $200,000 into millions does not require extraordinary genius. It requires ordinary returns applied consistently with patience and discipline. Steady growth may not make headlines, but it builds fortunes. Over time, consistency transforms average returns into extraordinary wealth. The contribution effect is what turns a strong investment plan into a wealth-building machine. Most people think of investing as a one-time event. They imagine putting in $200,000 and waiting for it to grow on its own. While compounding can do incredible things with a lump sum, adding regular contributions dramatically changes the final outcome. Small, consistent additions can multiply your results in ways that surprise even experienced investors. When you add money regularly, you are not just increasing your principal. You are increasing the base on which compounding works. Each new contribution becomes its own seed, growing and compounding over time. Early contributions have decades to grow, while later ones still benefit from the momentum of a growing portfolio. Over long periods, the total value of contributions can be smaller than the total growth they generate. This is how disciplined savers quietly become millionaires. Regular contributions also help you take advantage of market fluctuations. When markets are down, your contributions buy more assets at lower prices. When markets are up, your existing investments grow in value. This automatic behavior smooths out timing risk and reduces the pressure to predict market movements. Instead of trying to guess the perfect moment, you turn volatility into an ally. There is a powerful psychological aspect to contributing consistently. It shifts your identity from a saver to an investor. Each contribution reinforces the habit of paying your future self first. Over time, investing becomes automatic, like a subscription to your future wealth. This habit is often more important than the exact investment choice. The contribution effect also accelerates compounding in the later years. As your portfolio grows, your contributions represent a smaller percentage of the total, but they still add meaningful growth. More importantly, the discipline of contributing ensures that you are continuously expanding the compounding engine. Even modest monthly or annual additions can result in hundreds of thousands or millions of extra dollars over decades. Another overlooked benefit is flexibility. Contributions can increase when your income rises and decrease during difficult periods. This adaptability makes investing sustainable across different life stages. It also allows you to align your investments with your financial goals, whether that is early retirement, financial independence, or generational wealth. Turning $200,000 into millions is not just about what you start with. It is about what you continue to add. Regular contributions transform compounding from a passive process into an active wealth building strategy. They turn discipline into dollars and consistency into compounding power. Behavior is the hidden driver behind every financial outcome. You can understand compound interest, asset allocation, time horizons, and consistent returns, but if your behavior is undisciplined, none of the math will save you. Wealth is not built by intelligence alone. It is built by decisions repeated over long periods, especially when emotions are intense and uncertainty is high. Markets are designed to test your psychology. When prices are rising, greed whispers that you should invest more aggressively. When prices are falling, fear tells you to sell and protect what you have left. Both impulses feel logical in the moment, and both can destroy long-term wealth. The investors who turn $200,000 into millions are not those who predict the market perfectly. They are the ones who control their reactions when the market is unpredictable. Patience is a financial superpower. Compounding needs time, and time requires waiting. Many people sabotage their own growth by constantly checking their portfolio, reacting to every fluctuation, and jumping between strategies. Each change resets the compounding process and often locks in losses. Staying invested through good times and bad is one of the most difficult behaviors, but also one of the most rewarding. Discipline also applies to lifestyle choices. As your investments grow, so does the temptation to spend. A larger portfolio can create a false sense of security, leading to lifestyle inflation that eats away at your future wealth. The people who build millions from $200,000 often live below their means, even when they can afford more. They understand that every dollar not spent is another dollar compounding. There is also the behavior of continuous learning. Markets evolve, opportunities change, and economic environments shift. Intelligent investors stay curious, update their knowledge, and adjust their strategies without abandoning their core principles. This balance between consistency and adaptability is behavioral, not technical. Another critical behavioral trait is humility. No one wins all the time. Even the best investors make mistakes. What separates successful investors is how they respond to those mistakes. They analyze, adjust, and move forward without letting ego dictate decisions. They know that preserving capital is just as important as growing it. Turning $200,000 into millions is not just a financial journey. It is a psychological journey. Your habits, emotions, and decisions compound just like your money. Over decades, good behavior compounds into extraordinary wealth, and bad behavior compounds into missed opportunities. In the end, behavior is the most powerful investment you will ever make. As we wrap up, I want you to remember this: turning $200,000 into millions is not a fantasy reserved for hedge fund managers or Silicon Valley founders. It is a mathematical outcome that becomes possible when you combine compounding, time, smart allocation, consistent returns, ongoing contributions, and disciplined behavior. None of these principles are secret. The difference is that very few people apply them consistently for decades. Wealth is built quietly, through boring decisions repeated over and over again. It grows when you are patient, when you resist emotional impulses, and when you stay focused on the long term while everyone else is distracted by short-term noise. The real advantage is not intelligence, luck, or inside information. The real advantage is persistence. If you understand the math, respect the time horizon, and control your behavior, your money will eventually reach a point where it grows faster than you can spend or save. That is financial freedom. That is optionality. That is the ability to choose how you live, work, and give. The journey from $200,000 to millions is not easy, but it is simple. Start, stay consistent, and let the math do the heavy lifting.